The Chinese economy is stagnating. The prices of goods are plummeting. While most of the world's economies are battling inflation, China has a different problem, one that could be much worse. China's economy is experiencing deflation. This is both good and bad news for the world. Good because it means Chinese products are becoming cheaper, and bad because deflation may lead to a collapse of the second largest economy on the planet. If this were to happen, the world could be thrown into chaos, and every nation on Earth would feel its impact. Before we examine what's happening in China, we need to understand what deflation is. As the name suggests, it's the opposite of inflation. But what does that actually mean? And is it a good or a bad thing? We'll also need to analyze the causes and consequences of deflation before taking a deep dive into what is happening in China. This is a cautionary tale and one that every government should heed. Inflation is a huge problem for many economies right now, but if governments aren't careful and they overshoot their goals of getting prices under control, a much different problem might develop. At a basic level, deflation is when the prices of a country's goods decrease over time while purchasing power increases. You can think of it as the opposite of inflation in this way. When inflation occurs, prices of everyday goods such as foods, electronics, and housing increase. This means that consumers need to pay more money than they had to in previous years to procure the same products. Another way of looking at it is that due to inflation, the consumer's paycheck, savings, or money in general just doesn't go as far as it used to. Deflation is the exact opposite. Deflation of an economy occurs when the overall price of goods decreases over time, which means people can buy the things they need or want for less money. Again, another way of thinking about this is that their money has a higher purchasing power because they can buy more things with the same amount of money than they could previously. The tricky part about deflation is that although it sounds great for consumers, it can be detrimental to the health of an economy. The most common effects of deflation, if not handled properly by the government, are a recession and a shrinking economy. One reason for this is that as prices steadily decrease, consumers tend to delay purchases to try to secure a better price in the future. This is especially true for large purchases such as homes, automobiles, and expensive goods. The downside to this reaction by consumers is that it results in less profit for companies that are then forced to lay off workers. Financial institutions also begin to raise interest rates as they need to increase their profits, as their holdings other than cash might be decreasing in value. If this series of events continues, it can lead to high unemployment along with high interest rates, which can bring an economy to a screeching halt. In essence, a negative feedback loop is generated. As more people lose their jobs, they put less money into the economy and they're unable to buy as many goods and services. This then drives prices even lower as demand is much lower than supply. Prices continue to drop, leading to more layoffs, causing worse deflation, and the cycle continues over and over again until the government enacts policies and procedures to stabilize the economy. The question now becomes, what causes deflation, and is there any way for China to snap its economy out of it? There are two major causes of deflation. The first is when demand decreases in a country. For example, if consumers are worried about their financial future, they might begin to save more and spend less. This can happen if citizens don't have faith in their government or if a problem with the economy is looming on the horizon. In times of financial uncertainty, people who would normally be pumping money into the economy and buying goods might transfer their hard-earned cash into savings accounts to incur interest or create a fund to offer some kind of support cushion if things go bad. Demand can be stifled by several factors. If the government and financial institutions decide to raise interest rates, more people will save their cash and take out fewer loans. High interest rates almost always result in lower borrowing rates, and when consumers borrow less, they spend less on goods and services, which drives demand down further and further. Then there are large-scale events that are bad for the economy and therefore cause people to spend less out of uncertainty for the future, such as the global pandemic. People buy less because they're unsure if they'll be employed in the future. Economic and financial unpredictability almost always lead to consumers spending less and saving more. When this happens on a large scale for long periods of time, it can cause an economy to experience deflation. The second cause of deflation is if there's a sudden growth in supply and not enough demand to keep up with it. If companies find they're ending up with excess supply quarter after quarter, they will decrease the price of their products in order to sell them. This may lead to decreased profit or even a loss, but it becomes necessary if there's an excess of supply. Then there is the competition. If consumers are buying fewer goods than they had previously, the result is higher competition between companies offering the same or similar goods. This causes businesses to undercut prices in order to secure buyers. As one company cuts prices, others will follow to stay competitive. This snowballs into more price cuts, and the price of goods continues to decrease, resulting in deflation. The components necessary to build products will also decrease in cost with deflation. This allows companies to produce their commodities more cheaply, thereby giving them the ability to lower prices even more. A reduction in production cost results in a decrease in prices, which can then drive deflation in the economy. All of these things can result in more and more supply while demand remains low. So what are the actual consequences of deflation? We know what it is and why it happens, but how bad can deflation actually be for an economy and a country as a whole? It certainly is tempting to view a decrease in prices as a good thing if you're a consumer. And to be fair, having your money go further is a good feeling for most people. However, when deflation of an entire economy occurs, the results can be truly devastating. As we mentioned before, unemployment tends to go up in a deflated economy. This is because as prices decrease, profits decrease. Businesses cannot employ the same number of people if they're not increasing revenue and growing, so workers must be laid off. This is an inevitability in an economy that's going through deflation. And again, when people are nervous about their employment status being in jeopardy, they are going to spend less and save more. Then there's debt. Almost every nation in the world has external debt. This is because we live in a global economy and governments incur debt by taking out loans and borrowing money from external lenders to fund their own economic activity and public investments, as well as to increase employment. For example, the United States holds the largest amount of external debt in the world at around $24.5 trillion. The countries with the next largest external debt are the United Kingdom with $8.73 trillion in debt, France with around $7 trillion, Germany with $6.5 trillion, Japan with $4.36 trillion, and Canada with $3.2 trillion. China has the seventh most external debt in the world with around $2.64 trillion. The problem with having external debt and an economy experiencing deflation is that the country may be seen as a risk by foreign governments. This could result in the devaluation of a nation's currency, which is somewhat ironic, as deflation causes the purchasing power of the currency in the nation to grow stronger. However, on a global scale, deflation can decrease the value of the currency, which leads to problems when countries have to pay back some of that debt. The real issue with deflation is that there isn't a simple fix. It's a multifaceted and complicated economic situation for a nation to be in. The combination of low demand, employment uncertainty, and increased purchasing power continuously drives prices down. This, in turn, causes businesses to enact layoffs and lower their prices even further to get rid of supply, which can then cause the economy to come to a grinding halt. This is known as a deflationary spiral, and it's the reason why if deflation is not handled properly, it can lead to an economic recession. Now, let's look at China's specific case. This won't be the first time an influential economy has experienced deflation, and it certainly won't be the last. What has many analysts nervous and why we're keeping an eye on the situation in China is that it has the second largest economy in the world, with a GDP of around $17.8 trillion. Any problems in the Chinese economy will have ramifications for economies across the world, so let's find out what exactly is going on in China and how it'll affect the country where you live. When Chinese economic data was reported from the past few years, a few alarming numbers came to light. In 2020, both the Consumer Price Index and the Producer Price Index in the country started and have continued to trend negatively. The Consumer Price Index measures the changes in prices over time that consumers pay for goods and services. So, since the Consumer Price Index is going down, it means the average Chinese citizen is paying less for the things they purchase. The Producer Price Index measures the change in price that domestic producers receive for the goods and services they create. This number decreased for the past 10 consecutive months, from 4.4% to 4.1%. This means that goods in China are becoming cheaper. Both of these numbers show that the Chinese economy is experiencing deflation. China is the first G20 country to have a year-on-year decline in consumer prices since August of 2021, when Japan experienced the same phenomenon. China is the world's largest trading nation. In 2022, it's estimated that China exported $3.6 trillion worth of goods to countries around the world. Therefore, the price of manufactured goods and products in China has a direct impact on economies across the planet. As of 2023, it seems that Chinese exports are down by approximately 14.5%, and imports dropped by 12.4%. This is a huge decrease in exports, which is now having a drastic effect on the Chinese economy. The grim trade data reinforces concerns that the country's economic growth could slow further this year. Analysts believe that the recent property crisis in China may be one of the main factors causing deflation. As consumers, companies, and investors become more wary about unsold buildings and property, they are starting to spend and invest less. Beijing has continuously lowered interest rates and promised that real estate is still a good investment, but this doesn't seem to be the case, and Beijing is just scrambling to try to stabilize the situation. Also, the spending habits of consumers in China were very different post-pandemic than in most other countries. A majority of nations around the world saw consumer spending boom after the pandemic as people who had saved up while in lockdown began to splurge. This led to a supply issue as demand was so high producers couldn't keep up. In turn, this caused the prices of goods to skyrocket, which has led to inflation in many parts of the world. In China, it appears the opposite has happened. China remained locked down and had harsher COVID restrictions than most nations. However, once they were lifted, the price of goods did not increase in the country. Instead, prices began to fall as of February 2021. In retrospect, it seems the economy was on the brink of deflation for months due to weak demand for goods from Chinese citizens. And even when all restrictions were lifted, people didn't start spending their saved money in the same way residents of other countries did. There was no boom in demand, and therefore, supply increased. Chinese companies began lowering their prices to try to entice consumers to start buying, but it didn't work. Deflation continued, and now it looks like the Chinese economy could be in big trouble. Government debt is growing at unprecedented rates, while unemployment, especially in the younger generations, has hit a record high. Now, 12 million college graduates are looking for jobs that just don't exist, or if they do, they're not paying well enough. One of the problems with the enormous economic success that China has had over the last few decades is that more and more money has poured into the country. This has allowed a middle class to develop and higher-paying jobs to become more plentiful. But this success may be leading to China's downfall as companies are struggling to find new employees to work in factories and manufacturing facilities. The younger generations have grown up experiencing the economic success of their nation, and now they're not settling for minimum wage jobs in factories with horrible working conditions. Unfortunately, many recent graduates might not have much of a choice if the Chinese economy continues to trend downwards. But this is exactly what we would expect to see in a country that's experiencing deflation, high unemployment, and low prices. These two factors are also making it harder and harder for China to lower its debt. While Beijing tries to solve the deflation problems, the Chinese economy is growing more slowly than in the past and could eventually stall. And as real estate companies in China continue to collapse, consumers are holding on more tightly to their money while the government tries to get things under control. Unsurprisingly, Beijing claims there's nothing wrong. The leadership has told the Chinese people and all the world that its economy is stronger than ever and will continue to grow, even though all economic data suggests that deflation might hold it back. It's not entirely clear why, but Beijing hasn't enacted countermeasures to try to address the deflation issue. Perhaps they're afraid that if they start implementing ways to get citizens to spend more money and pump funds into their economy, then they'll have to admit that something's wrong. There's also the real possibility that Beijing only believes what it wants to believe and that they aren't doing anything because they truly think everything's okay. This seems unlikely as there are clear indicators that the Chinese economy is slowing as consumer prices decrease and employment opportunities are becoming more scarce. Liu Guochang, the deputy governor of the People's Bank of China, has stated that there will be no signs of deflationary risk by the end of 2023. Instead of facing the truth, Beijing keeps on insisting that the Chinese economy just needs more time to recover from the pandemic. Unfortunately for China, this is not what most economists outside of the People's Republic believe. It appears the Chinese economy is exhibiting almost every trait of deflation, and the reality is that deflation is not going away unless the government does something about it. But since Beijing seems to be sitting on its hands and refusing to acknowledge the elephant in the room, the next several years might be exceedingly rough for the Chinese economy. But what does this mean for the rest of the world? Will the deflation of China's economy cause a massive disruption to other economies across the planet? Surprisingly, China's deflation could be good news for other nations. Many economists have noted that deflation in China will actually help combat inflation in the United States and Europe. If cheaper Chinese goods are being imported and sold in the countries, it could lower prices and dial back inflation. However, there are several factors that suggest deflation in China will only have a very minor effect on reducing inflation in other economies across the world. For example, Chinese exports like furniture and apparel only make up less than 10% of goods affected by inflation. Things like housing, food, energy, and medical care make up the bulk of goods and services that have been hit hard by inflation, none of which is connected to cheaper goods coming from China. And even though China's deflation might help reduce inflation in certain circumstances, some governments would rather wait out inflation than speed up its decline by importing Chinese goods. For example, the United States has placed crippling tariffs on many Chinese goods to make them less enticing for buyers and to persuade U.S. citizens to buy more products made in the U.S., Mexico, and Canada. In 2018, President Donald Trump's administration started to bombard Chinese imports with massive tariffs. In response, China implemented its own tariffs on U.S. goods. This went back and forth for a while, resulting in around $335 billion in trade, or about 66.4% of China's exports to the U.S. being subject to tariffs. The average U.S. tariff on Chinese goods is now approximately 19.3%, while Beijing has settled on an average tariff of 21.2% for American goods. The result of this tariff war was an 8.5% reduction in trade from China to the U.S. and a 26.3% decrease in trade from the U.S. to China. And since the Biden administration hasn't rolled back any of the tariffs thus far, it's become too expensive for many U.S. companies to import products from China while keeping their costs competitive. This has resulted in businesses looking elsewhere to secure goods and labor, which has only exacerbated China's decrease in trade with the U.S. This has slowed the Chinese economy's recovery from the pandemic and might even play a role in the surplus goods that Chinese companies now have, which is one factor contributing to deflation. Rather than taking advantage of the extremely low prices of Chinese goods, the United States has doubled down on tariffs, and to be fair, the U.S. doesn't really need to purchase Chinese goods to help lower inflation, as the interest rate hikes by the federal government seem to have gotten it under control. There's also a downside to cheap Chinese goods flooding the global market, as Beijing tries to jumpstart its economy and offload oversupply. Nations that are willing to purchase inexpensive Chinese products might end up hurting their own manufacturing sectors. This could result in fewer investments at home and a decrease in growth and employment. A massive amount of cheap Chinese exports spreading across the world could have very real negative effects on both developed and developing economies. If China can convince other nations to buy more and more of its goods, it might be able to pull its economy out of the deflation spiral at the expense of saturating the global market and causing other economies to shrink. This is why governments around the world need to keep a close eye on what China's doing and introduce trade policies that will not hurt businesses within their own borders. For some, like the US, this is not an issue. However, for developing economies, cheap Chinese goods might be too enticing to pass up. Before we discuss how China can slow and even stop deflation of their economy, we need to touch on some other key factors in the process. We know that China's economy is experiencing deflation because its aggregate consumer price index has been decreasing steadily over several quarters. But we need to make a distinction between deflation, which is bad for an economy, and disinflation, which is good. These two economic terms may seem similar, but there are some very key differences. Almost everyone knows and has experienced at some point recently, inflation is miserable. It hurts the economy, businesses, and the consumer. However, deflation is not the answer to inflation. Inflation is a natural process in a thriving economy that needs to be managed. Problems occur when inflation rises too quickly. When there's a slow, steady rise in inflation, it often signifies that an economy is healthy and growing. Disinflation is when prices rise over time, but do so more slowly than when there are high levels of inflation. You can think of it like this. When inflation is high, a government wants to get it under control as quickly as possible. However, if done too hastily, increased interest rates and taxes can cause an economy suffering from inflation to collapse and plummet into a recession. Instead, what the government wants to do is implement a series of tax and interest rate hikes slowly over time to get inflation under control. For example, if the annual inflation rate decreases from 4% to 2%, this is disinflation, as inflation is still present, but at a much more manageable rate. The key difference between disinflation and deflation is that during deflation, goods decrease in price rather than rising in price slower than during inflation. Let's imagine a hypothetical cell phone that cost $100. If disinflation was occurring and the annual inflation rate went from 4% to 2%, this phone would have been predicted to cost $104 but would end up only costing $102. The phone still costs more next year than the year before, but the increased cost would be less because inflation was less. With a 2% deflation, that same phone would cost $98 the following year. Again, this might seem great for consumers, but it's all the other baggage that comes with deflation, such as decreased profit, layoffs, and reduced spending, that can result in an economy slowing down. There are a few things the Chinese government, and any government for that matter, can do to combat deflation. The first is to increase the supply of money through government buybacks. This is a balancing act, as the goal is to infuse money into the economy without devaluing it too greatly or too quickly. A sudden influx of too much cash could cause the value of a currency to plummet. If done right, buying back securities will encourage people to spend more money while also slowly raising prices. Both of these things need to happen in order for a deflated economy to grow. The government could also make borrowing easier by lowering interest rates or asking banks to increase the amount of credit people have access to. Another option is lowering the reserve rate for banks, which indicates how much cash each institution must have on hand at any given time. The lower the reserve rate, the more money banks can loan out, which can then be used by consumers to spend on commodities. On top of these actions, the government can lower taxes, which provides households with more disposable income and allows them to spend more. All of these things will result in prices increasing as demand increases. Basically, in order to combat deflation, the government does the exact opposite of what it would do to slow inflation. There are a few reasons why deflation may actually be more dangerous than inflation. As mentioned before, moderate inflation is part of a healthy, growing economy. However, deflation is almost never an indicator of a strong economy. Consumers can often protect themselves against inflation by investing money in the stock market, bonds, or interest-bearing accounts that will allow their money to grow over time. The hope is that the interest and dividends you receive will outpace inflation. In a stable economy, this often works, and even during times of economic turmoil or recessions, investing tends to be worthwhile in the long run. Deflation, on the other hand, often spirals into a recession or even a depression, which is much harder to predict and plan for. Debt that a consumer already has becomes harder to pay off when deflation occurs due to economic uncertainty and declining liquidity. When deflation is happening, people tend to put their money in cash investments, which do not earn as much over time and therefore hurt consumers down the road. This brings us back to what China should be doing right now. Let's start by saying doing nothing is a really bad option. By pretending everything is okay, Beijing may be digging its own economic grave. As the price of goods continues to decrease and supply grows, Chinese companies are going to have to start laying people off. China is still the most populous country in the world, with around 1.412 billion people. That's a lot of individuals who need jobs to support their families. And although there are other opportunities outside of manufacturing, China's economy is still heavily dependent on this sector. If Chinese companies start laying off workers to cut costs as a result of lower prices, China could be headed for a truly horrific economic crisis. Policymakers in Beijing still maintain that China's deflation period will be over within the next 6 to 12 months, and that the lowering of prices and the stagnation of the economy is just a side effect of the pandemic. Maybe they're right, but it's worth noting that almost every other developed economy is experiencing high inflation right now as a result of the pandemic. Some steps are being taken to boost the Chinese economy, but they're not necessarily addressing the real problem. Beijing has announced that China will increase the sales of cars and appliances within its borders while also making the housing market more stable and affordable. Most experts agree this likely won't fix the deflation problem and will probably only put a band-aid on the growing problem. If China has any hope of reversing deflation, consumers need to start spending money. This will only happen if they feel confident that the government and the economy are strong. The first thing that Beijing needs to do is regain the trust of private businesses so they'll continue to hire new workers and grow. This will allow their employees to spend more money and increase cash flowing to the economy. Many analysts have also suggested that China will need to enact tax cuts if there's any hope of encouraging people to spend their hard-earned paychecks instead of keeping them in their savings. If the government can get its citizens to start spending and businesses to stabilize their prices, then investors will once again begin putting money into the Chinese economy. In order for this to happen, Beijing might need to inject government money into the economy through a stimulus package or incentives for investors and businesses. The situation in China is slightly different than in Western democracies, as the CCP government has much more control over what is done in the private sector, along with how people live their lives. Therefore, it's on Beijing to fix the deflation of the economy by taking action. What it comes down to is that deflation can be very dangerous for an economy, and China is in the throes of a deflation spiral. Unless the government acts soon, the economy could go to recession, which might send the global markets into turmoil. At this point, every economy in the world is connected in one way or another. The problem is that China has the second largest economy in the world, which means that if something goes wrong, it will be felt by markets across the planet. Unfortunately, there's not much anyone can do to help China. If Beijing wants to save its economy, it needs to lower its interest rates, decrease taxes, and offer some kind of stimulus package. If this does not happen, the Chinese economy could be facing a recession or even a depression in the near future. Now watch what if the US economy crashes, or check out what will Russia's economy look like in 5 years.